Good?
Good.
Well, thanks for coming in. Andy from Pacific Life is going to go over some pretty good concepts on a product that was similar to some of the old people, look kind of like a money guard, but a little better. So it's a pretty good presentation. He's going to go through some of this. If you have any questions, he does have literature up here, so you can take some. You don't need it right now, so don't take it to look at it, Jake. That's what's upside down. But please listen up. I think it's got some good information.
All right, thanks, Scott. So my name is Andy Foster with Pacific Life. I'm the regional director for long-term care in the Carolinas, North and South Carolina. I just cover long-term care and our hybrid asset-based long-term care solution, I guess we say. Not the traditional long-term care. Traditional long-term care sales have gone down a lot, I guess you would say. You saw what happened with John Hancock. In the last year, they got out of business. Genworth, the Genworth product manager came out about, was it in 2015, and he said that one of the things that got them in trouble is they started having to raise their premiums on current policies, traditional policies. He was saying that their average payout in 2013 was 5.8 years. So the average payout, most people think it's 2 to 3 years, right? And he said that's true, but he said you got to listen to what they say. He said 2 to 3 years is just nursing facility care. He said people don't go straight into a nursing facility anymore, right? Home health care, right? So he said they're paying out 2 to 3 years in home care first, and 2 to 3 years in nursing facilities. That's where the 5.8 comes from. With technology and medicine as good as it is and getting better, that's probably going to continue to get longer. So I think most people understand the risk of needing long-term care. I mean, is anybody presenting long-term care or talk about long-term care with their clients? So I think everybody nowadays understands the risk. I mean, if you went back 20 years ago, they may say, well, my family will just take care of me. And we all know that's changed a little bit too, right? People moving around, everybody's working, so it's just different. The average cost of care in the state of South Carolina is about $78,000. North Carolina is about $83,000 for facility care. So if you take, and I've got the little statistic sheet up here, that's a client piece, but it just talks about what are the odds. It talks about what are the odds of your homeowner's insurance, your house burning down, what are the odds of you getting in a car accident, pretty low, go to an emergency room. The actual odds of getting sick if you're 65 and older is 70% of the people 65 and older will need some type of long-term care. So if you do the quick math, and I went to NC State, so I'm not great at math, but if you do the quick math, 5.8 years times $80,000 a year is about $480,000. So if you're 65 or older, you got about 70% chance you're going to have $480,000 liability, right? I don't usually go over that with clients because I think it scares them too much to make a decision. But what I was going to do for you is just go through my client presentation that I sit down with clients, because I think that explains how our solution is set up and where we're going at, what money we're going after, if that makes sense. So if we just look at the numbers, this comes from Long-Term Care Association of America, but 90% of Americans 55 and older are self-insured for long-term care. And it's not because they don't understand the risk like we were talking about earlier. They just don't, they think the only option for them out there is traditional long-term care. So they don't like it because they use it or lose it benefit, and premiums aren't guaranteed. So they say, the heck with it, I'm just going to take my chances. I'm going to put some money over here in the bank and have a rainy day fund. And if I need to use it, that's where I'll pull the money from, right? So if that statistic's true, what we did at Pacific Life is we built our solution to really target what people like about self-insurance. So we really mimicked our solution to go after the cash, the CDs, that type of thing. People are self-insuring, great. Here's a better way to self-insure. And I go through my client presentation, you see what I'm talking about. In the 5 years that we've been doing it, 80%, like the firms that we work with, they're telling us that 80% of the money that's coming in to Premier Care, our solution, it's not coming from investments, right? So you're not rating your investments, your constant annuities, things like that. 80% of the money's coming from CDs, money markets. So we felt like we've done a pretty good job in mimicking what people like about self-insurance. So let's go through an example. I think it's important to find out where we're getting business from. So let's say you got a 60-year-old male. You're sitting down doing your review, or you meet with a client, and you're asking some questions. You're going over your annuities, your retirement accounts. You say everything's pretty much looks okay. The one risk we haven't planned for, we don't have a plan in place for, is if you get sick. So what I'd really like to do is just write down what happens if you were to get sick tomorrow. Because that's really what you're finding out, what you can present to them, whether it's annuity with a long-term care rider, life insurance with a long-term care rider, our solution, or just do nothing and say, hey, you're just going to spend down your assets. So I think it's really important to ask that question. Say, look, let's write down what the plan is. What would you sell first, or how would you pay for that first year of care if you were to get sick tomorrow? Now notice I didn't say anything about long-term care. Do you have long-term care? Do you need long-term care? I think most people, when you say that, throws up a wall and they say, no, I don't want that stuff. So, but if you just position it as, you know, what's our plan? If you were to get sick tomorrow, how are we going to pay for that first year of care? That's going to cost you about roughly $80,000 to $100,000, right? Your first year, depending on what type of care you need. So how would you pay for that first year? And I've seen some people go down the list and kind of show, okay, let's just go through the 5.8 years that Jennifer says we need. You know, the first year you say, you know, well, I don't want to sell my investments, but I've got $100,000 CD at the bank. I'd probably use that first, right? What about year two? You know, now it's going to be now it's going to be closer to $100,000 in cost. Well, I got another $100,000 CD at the bank. You know, I'd use that. Great, and that's, when I'm doing client meetings, that's typically, just on average, I get to about $200,000. And then in year three, is when they say, well, I don't have any more CDs, you know, I'd have to go to my IRA now. Take out $100,000. How much money do you have to take out to get $100,000 out of your IRA? You pay taxes, right? $120,000, $130,000. You know, then the next year I need another $100,000. So go back to my IRA, it's another $120,000. Usually year 4 and year 5 is usually when the spouse, the female, is usually always bought in. She says, I understand the risk and do it. It's the husband that usually doesn't, for some reason, thinks they're going to live forever, shoot themselves when they get sick, which I've heard everything in client meetings. But it's usually when you get down to 4 or 5, his eyes get real big. He says, I understand why I need this now. Because now all these years I've worked hard at my job, building up my IRA, it's going to be all go away in a matter of 4 or 5 years. So that's when they really understand it. The neat thing about it is if you're telling me that first year you're going to use $100,000 and that CD, so you're self-insuring. You know, that's when I go further into the presentation and say, look, if you're self-insuring with a CD at the bank, there's 3 things that can happen. All right. Number 1, if you do get sick, if you live a good life and get sick, you know, you've basically got $100,000 plus interest to pay for care, because CDs are paying pretty good interest, right?
No.
No. So we'll just put a plus there. So if you were to get sick, you got $100,000 in that CD. If you were to pass away with that CD at the bank, you got $100,000 plus a little interest to pass to your family. And by the way, the only other option is if something comes up, life happens, you need to take the money out of the CD and spend it on something else, you got $100,000 to take out of the CD, as long as there's no penalty on it to get out early, right? So that's when I turn to the client and say, okay, we deal with risk every day. So out of these 3 things, what's the biggest risk you're taking on? What's the biggest risk? Is if you get sick, how long is that money going to last? When we just said over here, it's going to last for, let's say, a year and a half, right? So I wonder if we could just reposition this. What if we could say, okay, instead of doing this, we're going to put this over in Premier Care, same $100,000. If you were to get sick tomorrow, we can leverage your bucket up day 1 to $466,000, which is $4,800 a month, tax-free for care for a 7-year period of time. Okay. Because we can add an inflation rider on there of 5% at age 80, we put age 80 on our illustrations, it's because statistically people get sick at age 80 or beyond. 66% of people get sick at age 80 or beyond. So if with a 5% inflation, the benefit bucket grows, and by age 80 it's now $872,000, which is $9,600 a month tax-free for care for 7 years. So now we've turned your $100,000 into a much bigger bucket of money to help protect your assets. If you're to pass away, the death benefit in this scenario never gets below $115,000. It's not going to make your kids rich by any means. We're kind of opposite of what life insurance is doing. On a life insurance policy with like a chronic illness rider or a long-term care rider, they're going to give you a lot more death benefit, less long-term care. We're putting all our leverage into the long-term care piece of it, less for the death benefit. This is overcoming that use it or lose it benefit of traditional long-term care. So it's going to look a little bit like a CD rate of return for 20 years, right? But it's not a use it or lose it benefit. Where our business has grown, and we were up as a company, we were up 32% 2016 over 2015. And a lot of the reason was because right now, we're the only one in the industry that gives you 100% of your money back if you decide to quit at any time, day one, no 1099. You maintain full control of the assets, still on your balance sheet, just like it was back when you had it in a CD. But right now, we're covering your risk if you were to get sick. If you die, there's a small death benefit, but hey, there's no buyer's remorse. You do it today, day one, cover your risk. And think about it for 6 or 7 years if you want to, because it's always 100% liquid. The only risk you run here, and by the way, very few people ever pull the money back out of these things. But the only risk you run here, if you were to pull your money back out, is the opportunity cost of what you would have made in your CD back over here. Which right now, when I look behind, so right now, which risk is more manageable to you? Because you're not earning anything in the CD right now, so like you said earlier, you're not earning anything in the CD right now anyway. So the only cost of this is what you would have earned in the CD, which is money. It's a real sellable solution, and the biggest objection I typically get is it sounds too good to be true. Because how can you do that? Well, we have a bigger pool of risk.
Usually a scenario like this, a client would often say, okay, so if that's the case, how does the company make money?
Sure. And I'm straight up honest with them. So you know what? We're taking the money and invest it and trying to make it, delta, making more money on that money. Basically. Now the reason we can do that is our pool risk is a lot bigger than you yourself, right? Because if you get sick, you burn through your money. Now if we may have some people get sick for 12 years, we may have somebody get sick for 1 year. It's all going to average out. These actuary people are pretty smart. But does that help? I think that's just the way you answer. You say, we're taking that money, we're reinvesting and trying to make something out of that.
When you put on there no 1099, you're talking about the interest?
Yeah, so the reason I do that is because some of our competitors, one of our competitors has a similar product. MoneyGuard, yeah. So they have two products now. They have one that's a 20% surrender for life. So they've changed the story a little bit. Where if you ever get your money back, you only get in this scenario, you only get 80% of your money back. So people that have money in CDs, they like the control of the asset. They don't like to go into somewhere where they no longer have control of the asset. Now they also have something that's if you wait till the 6th year, there's another product that if you wait till the 6th year, it's like annuity surrender charge. So in the 6th year, you can get 100% of your money back, but there's a 1099, so you're still not going to get 100% of your money back. The way we structured ours different, so the way they structured theirs is, if you take the same $100,000 and put in theirs, every year they deduct long-term care rider cost, so it lowers your cost basis of the policy. So in 6 years, 7 years, if you get the money back, let's say your cost, I'm making up numbers, but say your cost basis is $80,000, they give you $100 back, and now you owe taxes on the $20,000. With ours, we structured it different. We just take it, we put the $100,000, we take the $100,000 and split it up 3 ways, day one. And because we do it that way, and all the buckets, the government says it's just a return premium, there's no 1099. And it's a lot cleaner, because what's going to happen when you come back to your client, the client's always here. They remember everything that you told them in the meeting, right? Probably not, right? So 6 years go by, they come back and say, okay, you said I get my money back, I'll give my money back. And you say, well, you can, but you're going to get $85,000 back. How's that going to sit? No. And that's why we've had so much growth in ours, is that it's 100% liquid, there's no buyer's remorse. It helps them make a decision and get off the bench and do something.
Yes, can you talk about the death benefit again?
Yep. So the death benefit, and ours is built on a universal life chassis. So it's a life insurance policy, basically. But what we're doing is we're trying to take more of the leverage and put into the long-term care piece of it, less in the life insurance piece. So in this example, and I've got this actual scenario and an illustration up here for male. It actually starts out about $137,000, but it never gets below $115,000 for a 60-year-old male. Most of the time with this, if you're younger, I'll take my example for example. When I was 38, I bought a life insurance policy with Harper. It had a chronic illness rider on it. So, but I'm married, I have 2 kids. What's my need? What's my purpose for life insurance? It's more death benefit, right? So for me, it made more sense to do a much higher death benefit, maybe less chronic illness, because I don't really need it right now. But it was really cheap to add on my policy. But the older you get, your need kind of changes, right? Now you need less life insurance, less death benefit, more long-term care. So with ours, we're going to give you a lot more long-term care for a 7-year period of time. just not as much death benefit. If the client's need, if the client comes and says, I really need life insurance, this is probably not something you would show, right? This is much more of a long-term care sale.
Like we're quoting MoneyGuard, you can actually move the numbers a little bit to slide it different ways. Can you kind of tip those scales and make, you said it's more geared towards long-term care, can you change it around at all?
You can take, like, with this inflation, we have a 3% inflation, so you can go down with inflation, take 3% and your death benefit's gonna go up.
Okay.
Or you take no inflation, death benefit's gonna go up higher, that type of thing. Or you can do instead of a 7-year benefit period, you can choose a 5-year benefit, because we have 2 through 8 years. So you can choose it and make the death benefit, or you can move it around, so it works the same way as.
Is there a residual death benefit on this?
There is, good question. So on ours, if you get, once you get sick, your death benefit goes down a little bit less than dollar for dollar. So whenever you start pulling money out of it, it goes out about a little bit less than dollar for dollar. So you could pull all of it out in, you know, a year and a half, right, something like that. But there is a residual death benefit. It's 5% of the face amount or $5,000, whichever is less. Try to make it really complicated, right? In this case, it's $5,000. Client would get $5,000 even if we went through everything. That's part of the death benefit goes tax free. We have to make sure it stays as a life insurance policy.
You say $5,000 or 5%?
Yeah, $5,000 or 5% of the original face amount, whichever is less. Policy.
As far as the application, one of the illustrations, is this all in the e-app format?
Yeah, you can do it all online. It's e-signatures, everything. We recommend you do it that way because it just, they can't mess it up that way. It's either goes through or doesn't. But you can do a paper application if you want to do a paper application. We do about 20% of our business in 1035 exchanges because it is put on a universal life policy. So if you find clients that have old whole life policies, maybe their need has changed, they don't really need death benefit anymore, but they got cash value and they need long-term care, you can 1035 get them a lot of long-term care with about the same death benefit they have. Other things, and I don't go through the application process too, because I won't go through that, but I did want to hit on this care coordination piece, because I think this is one of the biggest things that makes us different and things that helps you out the most. So when you get sick, that's when the real stressful time is, right? So you got your checkbook or your pocketbook right here. This is how you're going to pay for care, but a checkbook isn't necessarily a plan of action when you get sick. Because now the family's got to get together and figure out where we're going to send you. So what we've done in Pacific Life, you know, we're a mutual company, and it just means that we're owned by our policyholder and make sure we take care of the policyholder. So when we designed this, we built a plan of action on the back end of it. So we've got a little type piece in here. It's got some cards you can pull off, put your name, your phone number, policy number on it. When you get sick, call us, or have your daughter call us, or whoever. Within 48 hours, we'll send somebody out to your house who's a local registered nurse, CNA. They'll sit down with the family. They'll go over all the types of care in the Somerville area, whether it be in-home care, nursing facility care. They help you coordinate everything, so put everything together so you don't have to worry about it. They've been doing this for 20 years. It's a company called Long-Term Care Group. It's a great name, by the way, Long-Term Care Group. But it's like a white little concierge service on the back end. They stay with you through the benefit period. All 7 years, we use a 7-year benefit. If you need to make changes from in-home care to facility care, they help you do that. They audit the policy to make sure you're happy with your services. They'll even set up a direct, ours is considered reimbursement, but they'll help you set up direct bill of policy so you don't have to worry about receipts. I mean, it is like a white glove concierge service on the back end. And one of my biggest cases I've ever done was $350,000 dump-ins, husband and wife, guys in there worth $27 million. And I'm going to the meeting, I'm thinking, this guy can probably self-insure. And he got $10 million in cash, and his big thing, they get the leverage. I mean, if you get one of these illustrations, if you put in $100,000, and then by age 80, it's $872,000. That's a 9 point. It says in the illustration it's 9.7% internal rate of return, which is the tax-free equivalent. It's more like 12 to 13%. I mean, rich people they can take that money and leverage it up a lot, right? And that's a good benefit, but they also understand that they're used to being taken care of. They have everything done for them. This particular gentleman, he said, I don't want to have to count on my son to do all this for me. So he said, they'll do all this stuff for me. And he said, yeah, absolutely, it's all taken care of. So he liked that piece of it. And then you think about widows and widowers. I mean, who's going to help do all this? And for me, selfishly, I'm saying, you know, they're going to come to you when they get sick and say, you sold me this policy, help me do all this stuff, which you would do, but it's probably not what you're best at doing, right? So this way you say, hey, we've already got it covered. So I think that's a huge benefit. A couple of things.
What are the triggers on the long-term care piece?
So 2 of the 6 activities of daily living like dressing, eating, toileting, transferring, getting bathing, or a cognitive impairment would automatically trigger like dementia and Alzheimer's. We do have, not only do we have a single premium, but you know, obviously some clients can't do it all at one time, so we can split it up over 5, 7, and 10 years. That's pretty cool too, because the way it works is it's always 100% liquid. So let's say you're a 50-year-old male doing $10,000 a year or $833 a month into this policy on a 10 pay. It's always 100% liquid. So at any point, 5 years in, 6 years in, whatever, if you need the money back, you get the money back. We have a waiver of premiums, so if you get sick in the second year and you go on claim, then you don't have to pay any more premiums. And you get full benefit. If you come back off of claim, and then you need to start paying premiums again, but you don't have to pay the ones you missed. And then we have a reduced paid up option where maybe they're 5 years in and they lose their job or get divorced or whatever, and they don't have to pay anymore. They would keep what they paid for. There's a reduced paid up option that's built into the policy, so you know what that's going to be. So the multi-pay, that 5, 7, and 10 year gives you a lot of flexibility. You know, I think the single premium is great for those 55 to 70. We go up to age 75, I just think your sweet spot is 55 to 70. I think the multi-pay is geared more towards that 45 to 65 age range. You know, there's people still working, they don't have a single premium yet, but they're making good money and they can afford to do this over a long period of time. But they still have flexibility. If they need to get out, they get out, but it helps them cover that risk. Questions on that?
Long-term care training, do we need that for this, because it's based on the UL chassis, or?
You do need long-term, since ours is filed under long-term care, you would need your long-term care license. Underwriting, simplified underwriting. So, you know, I've got some knockout questions here. We don't want anybody to go through it that's not going to get it. So, you know, you got to be somewhat healthy to get it. So I've got some knockout questions up front. If they can say no to all these, then you can do the application, whether it's online or on paper application.
You don't look at medications at all?
We do. So what we do is we pull the medical records and we do a phone interview. There's no paramedics on it. So it's just 45-minute to an hour phone interview. If they're 55 and older, there's going to be a cognitive section where we're going to say here's 10 animals. Later on in the conversation, can you repeat back to me? They're not looking for 100% correct. They're just looking at not making up new animals or something.
Who is this again?
Unicorn. Say that. Go ahead. Good question. So you got a good question. Let me hit that. Finish up the. So it's just 45-minute to an hour phone interview. We pull the medical records, and then there is no paramedic exam, so we make a decision. It takes about 3 to 4 weeks for everything from time of application to getting ready. Question what we had up here was, is it qualify for the South Carolina Partnership Program? It does not count for the South Carolina Partnership Program. We're kind of targeting, you know, when we target, you know, these 55 to 70, 45 to 65, we're really, I think we're targeting people with assets of about 500,000 plus, somewhere around here. So to participate in the South Carolina program, you have to do a couple things that changes the way the policy works. And plus, even if you bought a traditional long-term care policy that would count, there's still a cap of 138,000 or something around there. So most of our clients that we see are fine, don't really want to spend down. So that's why we chose. That's a great question. Get that question on. What other questions do you have? Ours is just a real simple solution. I think that the trick is finding the asset. And I think you do that by asking a question. If people got there's trillions of dollars sitting on the sideline, right? Nobody wants to tell anybody about it because that's their rainy day fund. And if they tell you about it, you're going to want to invest it and put it into something for them. So they don't want to tell you about it. And it's just hilarious when you get the client meetings and you ask them something, they'll start talking about their CDs and they're like, you never told me yet all these CDs are here. And it's just amazing what you uncover. But if you take it from a planning approach, saying, you know, I just want to write down the plan. I want to make sure we have a plan in place. If you were to get sick tomorrow, what will we do? What's our plan? And by doing that, then they'll tell you, okay, yeah, I do have a CD in the bank there. They're willing to take their rainy day fund and make it into a better rainy day fund, as long as they know they still have control of still in the grounds. And it is. Something better comes out 3 years down the road, you can move it. If the government pays for long-term care for everybody down the road, you get your money. Who knows, dude? But I'll be happy to partner up with you. I do a lot of client meetings. I don't do many seminars anymore. Long-term care is kind of a dry topic as far as seminars go. Get people really excited about it.
Go to our nursing home.
Yeah, the funny thing is, I got a picture from a friend of mine about 3 years ago. He was getting to do a seminar, and guess where the seminar was at? Yeah.
He sold every single one.
I was like, I'm glad I'm not
Yeah, they're
too.
running the league.
I don't think he sold any. You're walking in with oxygen tanks. Too late. But it's, you know, if somebody calls you wanting long-term care, you know, they probably just came to the doctor's office, right?
Yeah.
But you know, with ours, again, it's just a simple solution. I think it's a real sellable solution. You just gotta set it up the right way, find the asset. There's a lot of people sitting on money that said, you know what, there's no risk. I mean, what's the risk? I mean, 100% of the time you're gonna get it back, or your family's gonna get back 100% of the money. I'll be around for a while if you have any questions or you want to. I have cards up here. I have a sample multi-page illustration. Best way to put it, call my internal. I've got some cards up here.
Okay.
So my internal's on the card, so it's name, date of birth. If they're married, they get a married couples discount, which I didn't mention, even if one of them doesn't apply. So if maybe one wouldn't qualify, or just says maybe he's already got a policy and the spouse doesn't, just because they're married, they qualify for the married couples discount. If they're a smoker or not, and then kind of what you're looking to solve for. You know, a lot of times we'll have people have a number in mind they want to start out today, grow to. A lot of times we won't have people, they don't want to cover everything. They say, you know, I think the cost of care is going to be about $8,000. You know, I got Social Security, so maybe I just want to cover $4,000 or $5,000. I want to make a little mistake rather than making a big mistake, right? So they're just trying to cover some of it. So it really depends.
What's the minimum age for,
Glad you asked that. Minimum age
for long-term care?
for long-term care. So I thought you were going to ask me what the minimum to put in for a single trade.
What's the minimum to put in for single trade?
There you go. That's what I'll ask you both. So the minimum issue ages are from 30 to 75. 30 to 75. The minimums, the best way to, rule of thumb is age times 1,000 is our minimum. We have to solve for a benefit amount of $2,500 a month. So if you have a 50-year-old male, it's going to be about $50,000. If you got a 40-year-old male, it's going to be about $40,000. If you got a 60-year-old female, it's going to be about $60,000 on the single premiums. And it's about the same, just divided by 5, 7, or 10 if you're doing 5, 7, or 10. The more you break it up over a 5, 7, and 10-year period, the less leverage. You get more leverage in a single premium than you would in a 10 pack.
So, what the price called?
Yeah, Santos is my internal partner. He's on that card. You can call me too, or shoot us an email and say, Andy, I got this client, this age, this, and this.
I guess what I'm asking is, you know, say if I'm in a client's house Saturday at 6 p.m., you're not gonna have anything. Yeah, so who's
Yeah, so
going
we don't have anybody. I wish we did. We don't have that. We don't
Yeah,
have that
I
service.
thought there might be like, you know,
There's nobody on call or anything like that.
nothing on.
Yeah, I mean, you can call me. I mean, if I'm available, I'll answer.
Okay.
My cell phone's on.
The price quote, you'll have it.
Is Santos on the West Coast?
He is in Omaha, Nebraska. Pacific Life is headquartered in Omaha, Nebraska. You would think we'd be headquartered in Pacific Ocean or something, right?
The address says Hawaii, that's what I asked.
Well, it's actually a neat story. We're in Newport Beach, California, where our corporate headquarters are now still, but for the state of California, wherever your company's located, is where you pay the taxes on your life insurance policies. So by relocating to Omaha, Nebraska, we save like a lot of money for our policyholders. So that's why we moved to Omaha, Nebraska. So it's a neat story. Does anybody know where who founded Pacific Life?
A whale.
No. So,
You're very close.
so Pacific Life was founded by Leland Stanford, who also founded another college down on the West Coast, Stanford University. Stanford University, down on the West Coast. He established Pacific, founded Pacific Life. They bought the first life insurance policy. And founded Stanford University, which is actually called Leland Stanford Junior University. That's the diploma says there. He passed away, and actually they were going through a rough time, and he was paying all the professors. And Stanford University, when he died, almost went under because now nobody was paying the professors. And then his wife took the life insurance proceeds from the Pacific Life policy, paid the professors for the next 3 years, kept the university going. That was a pretty neat story. Yeah. So you would have like Hewlett Packard, PayPal, all this other stuff. So, pretty neat story. It's on our website if you want to look at it. But yeah, I'll be around for a little bit. That's it. Like I say, it's a real simple solution. I think it's real sellable. I'd love to partner up with you if you have any questions. I'll be happy to help out.
Is there anything like this in an illustration already? I write things all the time anyway, but is there like an actual like pre-printed out?
Yeah, this is so.
You had an example. You said you had an example.
Yeah, so this is the same numbers. These are the same numbers from this illustration, 60-year-old
Okay,
male.
but it's like a
So
regular.
it's on page 4 of the illustration. It shows you if you live and get sick, these numbers. If you want your money, if you quit and want your money back, if you pass away, it never gets below 115. Then it shows on the next page the same numbers, just written out a different way. You know, I didn't mention the elimination period. We've got a 0-day elimination period for in-home care. So we built a policy how you want to use it. Most people want to stay at home as long as they can and go to a facility. We have a 0-day elimination for in-home care, assisted living, a 90-day elimination for facility care. Any time spent in the home counts towards your 90 days.
Is that flexible at all?
0-day for in-home,
Yeah,
90
assisted living.
and assisted living. 90-day for in-home or facility care. Any time spent in the in-home counts towards you.
It says 90.
And we've got an easy view page on the back of the illustration, which is pretty cool because it shows you. We ran these as a 7-year, but this shows you 2 through 8 years and all the inflation. So if you want to like build it like you want to build it, you can look at that last page rather than running a bunch of different illustrations. And I've got an example of a 10-pay up here as well. Care coordination and knockout questions.
Any questions? No?
Thanks.